for joining us today for Accounting for Beginners. We are so excited with the record high turnout today. Today we will be discussing installment sales and construction in progress. We will look at the differences in treatment for financial/book purposes and for tax purposes. First, we're looking at installment sales. Installment sales are a financing agreement in which the seller allows the buyer to make payments over an extended period of time. For financial accounting purposes, companies have a choice to either recognize income all at once or recognize income over a period of time. If they recognize income over a period of time, this requires an agreement between the buyer and seller called an installment contract. Okay, so here's an example. In 2015, company bought land for $200,000. 4 years later, in 2019, Company A sold land for $500,000 to Company B. The gain is the selling price minus the book value of the land. Therefore, the gain is $500,000 minus $200,000, which is $300,000. So, if Company A elected to not use the installment sales method, they would recognize all of the $300,000 gain in year one. If they were to elect to use the installment sales method, Company A and Company B would enter into agreement for Company B to pay for the land in 5 equal installment payments. The first payment will occur in year one. Therefore, Company A will recognize the $300,000 gain over 5 periods, which is $60,000 each year. Any questions?
So why might someone elect not to use the installment sales method for book purposes?
So one might not elect to use the installment method for book purposes, just so they can recognize all the gain in a single year. Therefore, their revenue would be increased for the whole gain rather than recognizing it over time, which would make revenue look better in year one and would make management look better in year one. All right, so next we're going to talk about the installment method for tax purposes. For tax purposes, companies also have a choice to recognize income all at once or recognize the income over a period of time, which it still requires an installment contract between the buyer and the seller. So we're going to use the same example that we did for book purposes, but one thing different is that to calculate the gain for tax purposes, it is the selling price minus the tax basis in the land. Therefore, the gain is $500,000 minus $200,000, which equals $300,000. So if Company A were to elect out of the installment sales method for tax purposes, they would recognize all of the $300,000 gain in year one. So if we were assuming a tax rate of 20%, Company A will pay taxes of $60,000, which is $300,000 times 20%. Rather, if they were to elect to use the installment sales method, Company A and Company B would enter into the same agreement for Company B to pay for the land over 5 equal installment payments. So therefore, Company A will only recognize the $60,000 of gain in year one and only pay $12,000 of tax in year one, assuming the same 20% tax rate. Okay, any questions?
So for tax purposes, why might someone elect to use the installment sales method?
So for tax purposes, one might choose to use the installment sales method because they would not recognize all the gain in year one. They would spread their income to future years, and in a period of falling tax rates, they would pay less tax in the long run. Thank you for your time.
12 seconds later.
Hey everyone. Okay, so up next we're going to talk about construction in progress, looking at the revenue recognition for the construction industry. So there are 2 main methods, the percentage of completion and the completed contract method, which are used to recognize revenue by construction companies, engineering firms, and other businesses that operate on long-term contracts for large projects. Okay, so what are these 2 methods? Well, the first one is the percentage completion method, which states that the contractor recognizes revenue over the life of the construction based on its completion percentage. So that means that if a contract is 50% complete, then you'll recognize half of the revenues, expenses, and income. So what is the completed contract method then? Well, that method states that all revenues, costs, and income are only recognized upon the completion of the construction project.
I have a question. So how do you know when to use which method, since there are 2?
Good question. So it states that as long as particular amounts of income and expenses can be attributed to each completed part, whether via percentage calculation or some defined milestone, then the activities are reportable and the percentage of completion method must be used. Just as long as the revenues and costs can be reasonably estimated and the parties involved are expected to be able to complete all duties. So likewise, on the other hand, it is recommended to only use the completed contract method when the project completion date is unknown or may be changed. Okay, so now we're going to look at an example. First, we're going to look at how to use it with the percentage completion method. So our example states that a construction company is building an office complex that is under contract at a sales price of $100,000. The company estimates that its total expenses will be $60 million. So at any point in the construction process, it can report completion by percentage. So therefore, if the project is deemed to be 30% complete at the end of the year, the business would report 30% of the $100 million of project revenue, which is $30 million. The firm would also report 30% of the $60 million in expenses, so $18 million, which would lead in a result of current gross profit of $12 million. But looking at this example using the completed contract method, the firm will report all of the $100 million in revenue and $60 million in expenses when the project is complete. And this will result in a current gross profit of $40 million.
What are the pros and cons of using each of the methods?
Okay, so looking at the two methods, for the percentage of completion method, for book purposes, the firms will report higher revenues sooner, but for the completed contract method, they're able to defer these revenues for tax purposes and potentially pay less taxes. However, it is still challenging to prove to investors the value of the company during times of little to no incoming revenues, but it's still the most conservative accounting method for companies working on long-term contracts. Additionally, however, if a contract is set for completion in 10 years and the business may not incur taxes on that project's income during that time if they use the completed contract method. However, tax laws can and do change from year to year, and if they were to increase during any point of that 10-year period, the company faces paying higher taxes than it would if reporting occurred sooner in the process, such as by the percentage of completion method. So thank you for coming today. I hope you learned a lot about the installment method and the different revenue recognition methods for the construction industry.
Later that same evening.
Dear Dr. Key, today I learned that installment sales are a financing arrangement in which the seller allows the buyer to make payments over an extended period of time rather than all at once up front. For financial reasons, the company can choose whether or not to use the installment method. If they elect to use the installment method, they recognize income over time rather than all at once. Management may want to elect not to use the installment method, as recognizing the entire gain from the sale at once would make revenue figures higher. However, using the installment method is more conservative as revenue is recognized over time. Someone might choose the installment method for tax because you recognize the gain over time. In periods of rising tax rate, you would pay less tax in the long run than you would if you recognize the entire gain in year one. I also learned about construction and process. There are two methods to recognize revenue for the construction industry. The first is the percentage of completion method. This is where you recognize revenue over the life of the construction contract based on the actual completion of the contract. There's also the completed contract method. This is when all revenues, costs, and income are only recognized upon the final completion of the construction project. So I also learned when to use each method. You use the percentage of completion method when amounts of completion are known, and you use the completed contract method when amounts are unknown. The percentage of completion method reduces the risk of fluctuation while affording tax deferral benefits. The completed contract method is a riskier method. However, for companies working on long-term contracts, it is the most conservative accounting method because revenue recognition is deferred until completion. For tax purposes, in periods of rising tax rates, the completed contract method would result in higher taxes as opposed to the percentage of completion method. Thank you for recommending this Accounting for Beginners seminar for me. I really learned a lot.